Hey everybody, welcome to Trading Capital's daily analysis video. Wrapping up the week with the spiders here. What a power rally in the markets. And this is exactly what we were expecting. We kind of prepared all of our members on Thursday's wrap-up video for this light volume Friday. And when light volume heading into a holiday, historically probabilities favor a massive float up. And that's certainly what we got. Noticing on the spiders here, we gapped open, and essentially from that gap, we never looked back. It was just a push up, consolidate, another leg up, consolidate, another leg up, consolidate, consolidation, and then another final push up late into the afternoon. So a magnificent day. This is why we slowly accumulate our long positions into oversold technical levels, because the markets will get that inevitable bounce. And we're certainly, this is the factor why we accumulate slowly. And some people will call it catching a falling knife. I beg to differ with that. It's accumulating at smart technical levels, where often big money is also accumulating, smart money is accumulating, and dollar cost averaging our positions to put us in the money when that inevitable down bounce comes. Now, what you have to understand is the Federal Reserve is tightening, so yes, the markets are going to go lower. But the reason why there's still inevitable bounces to occur is because when you factor in how much liquidity has been pumped into the system over the last 20 months and quantitative tightening hasn't even started yet, sure, interest rates are starting to spike and peak up, but the liquidity is still in the system. That money hasn't been removed. When you look at the balance sheet of the Fed, it's still pushing, astronomical levels, 8 trillion plus. It was close to hitting, I believe, 9 trillion there at one point. So essentially, with that much liquidity still in the system, the bounces will come. Now, once QT is in full effect, they're starting off with gradual QT, and their plan is to ramp it up. Whether or not they succeed with that, time will tell. But jumping into the spiders here, magnificent rally. The spiders finished up over 2.45% on the day. And if we flip to the intraday chart here, essentially you can see this this longer term trend line that we broke out of, and we haven't looked back. Now, at some point, I do favor a retrace back to at least this support zone, which was your old gap fill, and this rising trend line. So that will be, I guess, your first area of support. It might coincide with a move all the way over here, where these two lines intersect. But notice how we've blasted through major resistance. This was a major resistance which you blasted through with ease. And now you're into this chop here. You blasted through this major pivot, and you've blasted through these little pivot highs. And now you're into this little bit of a chop, which is a wide range sell-off zone. This was your reversal. So this is going to be your next area. There is a strong probability that we do go up there to fill that gap, that intraday gap. So that'll be your next area to attack. If we can get through this wide range bar of selling, then we ultimately have a chance to go fill this gap fill at the 428 level. But that might be a big stretch for the markets. The markets have had an impeccable move off the low, and there will need to be some consolidation. We will probably start to see the markets run out of steam as that liquidity dries up. If we flip to the daily chart, let's just go to this. You can see this was our intraday line. This is our level of support now that we've blasted through. And notice how we've had a 1, 2, 3, 4-day surge off of the lows. So we were tagging the support, teetering on the support, making investors really nervous. There was a couple fake outs where it looked like you were going to close below, another fake out here, and then ripped back up. And this is the importance of waiting for confirmation, whether you have a breakout or breakdown. But this trend line, this parallel line, is still acting as a decent level of support. And it does look like we're going to eventually fill this gap to the upside. That's certainly where the momentum is heading. But you have to remember, this was an extremely light day for volume. 84 million, 82 million the previous day. That's not your typical high volume day. That being said, I do think there's a potential that we could, before we fill this gap, we could potentially come back down and fill this gap. And then you also have a secondary gap down here. So I do think that these markets could potentially roll over, fill these key technical gaps before ripping up. And what will happen is, once this market starts to roll over, there's a lot of investors that are potentially going to think, oh, here's the next down leg, it's automatically going to start, let's pile in the shorts. They fill these key technical gaps, and then it could easily rip and float back up for another week, maybe two if we're lucky. But congratulations on taking profits. We have been diligent in closing and taking off our long positions as the markets rally. We always want to sell into strength. No one has ever gone broke from taking profits and selling into strength. Often people are reactive instead of proactive when it comes to investing and trading. Never feel guilty for taking profits, especially when they're double-digit gains. But I just want to congratulate people on MRTX. This was a beautiful day trade and a swing trade alert that I issued to everyone. I did a swing trade and a day trade. When I issued the day trade around this, what was the issue? 33.81. I issued the day trade for. So it's a beautiful pickup. You can see it's right on this dotted, this green line level here, which we picked it up. And I managed to close it out for a 6% gain. I had a swing and a day trade that I was playing. And my day trade, I usually, can take anywhere upwards of 10 to 20% of my entire account. So that was an impeccable gain. Again, some people say this is catching the falling knife. It's very dangerous to do. However, catching the falling knife is just an easy term thrown around for people that don't understand how and what signals to potentially trade and look for when you're catching a stock that's falling 20, 30, 40, 50%. I wouldn't even say it's catching it, because catching it is just throwing up a blind eye like this person or this group of buyers did here. This group of buyers did here. This group of buyers did here. So catching a falling knife is often referred to those that don't understand technical analysis. There are clear signals that you can use to see when a major pivot low is in effect. And that's certainly what happened. As soon as I started seeing the volume trends change, that's when we went long, and we keep a tight stop loss. And that way we mitigate our potential losses, our downside, while maximizing our potential profits. And if you kept this stock earlier, at the one point it was up 14, at the highs it was up 19%. So we sold over here at 36. I'm very conservative. I like to get my money in and my money out. But nonetheless, you could have held that for double, triple the gains as to where I got. So congratulations on that one. We also sold Teladoc for a beautiful 17%. So congratulations on that big win. And then we also sold Apple for a beautiful 7.7% gain. If we flip to Apple, I'll show you why we sold Apple. Whoops, I can't type this morning. So Apple, and so if we take a look at Apple, Apple has had a tremendous move off the lows. And remember how we were watching that inverse head and shoulders? It's actually very, very beautiful to see on the hourly chart. Left shoulder, head, right shoulder, breakout over here. This is where we were averaging around the 138 mark, and we just unloaded around 149 and change. The measured move of this inverse head and shoulders is over here. I do think the reason why we started taking off longs and reducing some of our exposure on like Amazon is because the markets have had a strong power move. I do think that they can potentially roll over a little bit and fill some key gaps on the downside. Like Apple, you have a key gap over here, which is likely to be filled, but you're into your first level of resistance. Not only have you pierced this channel that you broke out from, so this is your original breakdown zone, which you've now recaptured, but you're also into the measured move of the head and shoulders, and you're also into your first major pivot here, which you can see over here. So I like to take my profits when there's strength in the market instead of watching them potentially roll over and missing out on that trade. We still have plenty of longs on the table, as well as new shorts that we've acquired. If we look at ACHR flying vehicles, I think that says enough. We're in a tightening cycle. The fact that flying vehicles are popping up over, it was up 19-20% on the day, just shows that these types of stocks are going to get obliterated. The highly speculative ones, the ones where the tech is not needed for, I would argue, at least decades, is certainly going to be the ones that get crushed. And the beautiful thing about ACHR Aviation is if we've played this 3 times on the short side. We've played it up here, and we covered for our short at this gap fill. We played it up here, and we covered for this short at the gap fill. Now we're playing it up here again, and I'm looking to cover at this gap fill or the end of this wedge. And institutions are notorious for looking like a potential breakout in a wedge formation is going to occur. So you can see this is clearly in a downtrend, but it's been bubbling up against this wedge. And I certainly think that, yes, it could potentially go a little bit higher, which is why we accumulate small positions. but I do think this stock comes significantly lower just due to the fact that it's flying vehicles. We're in a tightening cycle, and speculative money certainly does not favor speculative investments during a tightening cycle. A couple other things we did was short DXC. So DXC, one of the reasons we shorted was we filled this gap up here. You notice our average is still in the money right now after our first leg in on the short. If this goes higher, we do have some secondary resistance lines up here that will act as your next area of resistance. We will look to short up in these levels, add to our short if we start piercing and testing these upper resistance lines over here. Another thing that we're shorting is ITB, which is a direct correlation to the real estate market. It's construction. I'm in the camp that real estate market has to see some sort of a decline because we have not experienced quantitative tightening in over 12 years in the form that we're going to experience. When you look at interest rates alone, it's up to the 2008 highs, which is pretty scary because what followed in 2008 was one of the greatest housing crises that we have experienced to date. So with high interest rates around the same levels, and then you throw in the Grim Reaper of QT, I do think real estate has some significant headwinds that will push it much, much lower. Where do I think ITB goes at the lowest? Well, I think you have to retrace to this COVID high. Notice we've had this power move off of the lows. You do potentially have this gap that you're looking to fill up here. We'll look to add to our short. If you push higher than that, then we'll look to short at the top of this parallel trend line. And let's take a look at Amazon. So Amazon, we sold half of our position for a small gain today. One of the reasons I did that was I am fearful that these markets could have a rollover and potentially come and fill this gap down here, which would be a 3 or 4% drop. And then there's also a secondary gap fill over here, which would be more likely a 6-7% drop. So I wanted to just scale back some of our Amazon positions. We still have, I think, 2.5% position of our portfolio in Amazon. So we still have a fair amount of the long on the table in the event that Amazon pushes higher. If Amazon continues to come lower to potentially fill this gap, I will look to maybe add another 1% down there, which will actually lower our average, and then eventually we could potentially push up to fill this gap around the 2,500 level. Now, there is a stock split coming up, so there might be a lot of hype around Amazon. Just remember, stock splits don't really change much. Stock splits really only suck in smaller investors to be able to buy a stock like this. I mean, when a stock is trading at 2,300 and you have a split, and especially it's a 20-to-1, that's a tactic that institutions use to lure smaller investors into a stock that is likely to head lower. And when you look at the stock splits over history, initially a lot of them have a pop sucking in that retail money, and then institutions come in and crush the stock down. So I urge people to be very cautious. We may get that pop. If we get that initial pop up to gap fill over here or into any of this resistance level here, then we will look to sell our Amazon again and offload that position for another gain. I'm just reviewing what else was transpired over the weekend. So we also added to our BX short. Let me just pull up BX. So BX short, you can see we added at this green line here on the 121.30 level. Again, you're into this red bar resistance. There is a chance that you can come up to test the top of this yellow trend line, but you are heading into some major resistance. If you get through this yellow trend line, then your next level of resistance is going to be this upsloping trend line, which was kind of your neckline of this weird head and shoulders that that you did trigger. So I do think there's tremendous more downside for BX in the near future. Notice how you have been stuck in this wedge and now you're going to the top of this wedge. So expect tons of resistance at this yellow trend line. We are sitting in a pretty decent average for this inevitable decline to happen. At the very minimum, I think this goes to fill this gap around the 100 level, which would be a nice double-digit 13% gain from our level. I do think eventually you break this trend line. You're kind of been stuck in this wedge formation now. And ultimately, I do think this wedge has to break at some point for you to eventually go back to your longer-term pre-QE trend. So again, we have a lot of stocks that will eventually mean revert to their overall trend. If we take a look at natural gas had that beautiful reversal candle on volume, and then it was followed up by a secondary confirmation candle to the downside. The thing about natural gas is it did fall a lot lower during the day, and then it got bought back up. And this just shows you that there is strength still under natural gas, but I do think that people are ultimately going to be getting sold into as we go forth over the coming weeks. I do think those bulls will eventually run out of steam up until this support line over here, the 650 area, where it'll be your big support. I think all the buyers that have been buying in here are going to get crushed very, very hard, just due to the fact of the nature of the volume that is coming into play and this reversal signal over here, especially since it's a topping tail mixed in with a bearish engulfing candle. So stay tuned for more up or more downside on natural gas. That's generally what the technicals are pointing to. So we'll just have to monitor that by ear. If we take a look at Dollar Tree, DLTR is still up from our short. We are shorting that at 158.54, our level. I do think Dollar Tree comes in pretty substantially over here. There is a chance that you come to double top. We'll look to accumulate more of a short position there. If you get through double top, then you have this trend line of resistance. We're also shorting Pfizer, PFE. So Pfizer is putting in some beautiful sell signals, distribution signals. It looked like you were breaking out of this wedge, but you've actually had a failed breakout with a daily topping tail. So that's good to see. We currently are in the money, and I do think this will see some substantial downside at the minimum to this gap fill down here, but ultimately to the low range of this wedge. And I do think since you're trying to break out of this wedge and it looks like you're failing and you've had a confirmation of a fail, I do think you eventually will break this wedge to the downside. Your next area of support will be this pivot. This was your original breakout before going to new highs, and then you'll have a trend line connecting through these levels of support and chop, a pivot, and it'll coincide with somewhere probably around this 45, 46 level. Ultimately, there is a massive gap fill around this 43 area that I do think gets filled in the not too distant future. Another stock that we can take a look at is, let me just scroll through our list here. So yeah, we covered our Stoneco, we sold our Baba. We still have Netflix long right now. That finished up on the day on Friday, up almost 2%. So closed above the 196 mark. So that's beautiful to see. We still have Spotify on the table, which we're deep in the money on Spotify. A beautiful over 17.5%. And let's just pull up Spotify for a quick second, just so we can go over that. But Spotify is looking great for us right now. I love Spotify. That recurring subscription business model is generally easy to forecast in terms of finances and balance sheet and projections. So I love Spotify for that simple reason. Also, I love Spotify because it's trading below its IPO levels. It's relatively, on a historical basis, the cheapest the stock has ever been when you factor in revenue, profits, debt. It's literally the cheapest the stock has been. It has more subscribers than it did on its initial IPO, and it's trading at a cheaper level. And look at this beautiful, one could argue it's this inverse head and shoulders, kind of like the Apple chart, where you have this left shoulder here, your head, and this can be a big right shoulder. But nonetheless, even if it's not a inverse head and shoulder, which arguably you just broke out of, and a measured move takes you up to this gap fill, which is 136, but even this bullish price action here, I really, really like this pattern of this initial flag, and you just had this tight consolidation, upwards consolidation. You've now broke out and confirmed. So if we flip to the daily chart, the first gap fill intraday takes you up to this this area here, this 137. You have your next resistance at this pivot, which, due to the price action, if the markets continue to catch a bid, I do think you can rip through that and eventually tack this gap up over here first around 132, and then this intraday gap up here at 137. So that'll be a substantial gain for us if we get all the way up there. That looks like a 43% gain. Again, that would take a substantial underlying bid for the markets to certainly get up there. If we look at oil is bubbling up against this top of this resistance. Every time it's got up here, 1, 2, 3, 4, it's pulled back. Oil is bubbling down or up on the fact of EIA inventories, massive drawdowns, And obviously with the peak season, so to speak, of oil consumption traveling and whatnot have you, there's obviously a lot of bullish fundamentals on oil. I still think that with midterms, you're going to see a lower oil price. There might be a chance that you come up to test this double top or a pierce of a double top, but I do think oil should come down at some point in the near future. That's it for today. Thank you all for being members. Monday, the markets are closed. The U.S. markets, Canadian markets are open, but U.S. markets are closed, so most of the volume and liquidity will be dried up on Monday. That being said, we'll continue to look to take profits on our long positions if the markets continue to rally and float up. So be ready to bank more profits. Excellent job with position management, risk management, and understanding the key technical levels is ultimately going to trump everything. Right now, realistically, no fundamentals matter about a company. Only the technicals matter, and what the biggest fundamental that does matter is what the Fed is doing. That's really the main macro factor that you need to be aware of. And we've just been slowly accumulating over time. And in 2022, when most of the markets are down, even if you're conservative playing the S&P, you're down about 20%. The NASDAQ down about 28%, maybe a little less now with the rallies. But that being said, people have been getting killed in 2022, and we have been printing profits galore. We want to stay humble. Ultimately, the most difficult time to make money is in a bear market, and since we're making money in a bear market, I can't wait until we're back into that bullish momentum, that uptrend where we can just go long and not really have to be as nimble as we are, and as cautious with our risk management at the moment. So thank you all for being members. Hit a like, hit a subscribe button at the bottom. Hopefully all this free content is helping people navigate these crazy, treacherous times. You know, the falls have been precipitous across many trading weeks, and it looks to be that we're going to be negating that 7-week downtrend. Well, we did negate that 7-week downtrend with a positive weekly close. So now that's 7 weeks of down, 1 week up. Will we get a follow through second week? I think the second week will be a little more choppier than this last weekly rally. Thank you all.